welcome back. It's not a pleasant morning, Boxing Day, and it's the bulls who are getting punched today and punched across the board. Sensex and Nifty down over 1%. Mid-caps almost racing to a 2% downtick. That index, it's down 310 points. And the bank Nifty almost getting to a 1% downtick. So it's about 5-6 stocks in the red for one in the green. Difficult morning, so we're getting you more experts to advise us. Gautam Duggad, the head of research, institutional equities at Motilal Oswal, joins us now. Good morning, Gautam. Thank you very much. And sorry for pulling you all out. I guess you all would have liked a quiet last week, but the global markets are not allowing you. What is your sense? The global backdrop looks extremely troubled. Are we heading towards 10,300 in terms of a support, or does this environment look even worse?
Good morning, Lata. Merry Christmas and New Year wishes to your team and your viewers. I think what has happened in the last 10 or 15 days is a reflection of aggravated worries about the global growth. And one of the points you were mentioning before you went into the break, that crude oil at 50 and possibly even below that, while it augurs very well from India's macro point of view, our sweet spot, if I can use that word, is around $50 to $65. But that being said, I think the worries about global rate tightening, shrinking of the global central bank balance sheets, and the fear about US economy slowing down, all of that has overtaken the local fundamentals. But if you look at our own fundamentals in the last 2 months, we have seen a big improvement in our macro factors, be it crude or currency or bond yields, and earnings are looking the brightest at any given point of time today in the last 5 years. So while 2018 has been a very difficult year, and December is by and large reflecting what we have gone through in the entire year, 2017 was obviously a extreme reversal of what we have seen in 2018, extremely calm and serene year across the globe. 2018 has been anything but that. And I think 2019 we might see some spillover of volatility and global concerns, especially in the first half. So it's going to be an interesting first half in 2019 for sure.
Well, Gautam, as you said, it's going to be about earnings, right? I was looking at it maybe a year or so ago. You all were factoring in a 25-26% EPS growth. And that's been scaled down drastically to around 12 to around 15%. FY20, do you all believe that 24-26% that we've been talking about for so many years, is it coming?
Nigel, as you would have seen in the last 4 or 5 years, the earning projections of the street have been penciled down significantly every year for one or the other reason. As we step into 2019, one of the things that we have to keep in mind is that even FY20, the numbers that are being projected, 24-25% growth, is largely led by, as far as Nifty is concerned, the 3 corporate banks. And that is where we've been very bullish in the last 6 to 9 months. I mean, if I were to just segregate the Nifty earnings growth for FY20 of around 25%, and if you leave aside those 3 banks, then for the rest of the 47 Nifty companies, we're talking about an earnings growth of around 14.5%. So last 4 years, when you look at the Nifty earnings growth, it has been disproportionately impacted by the same 3 set of banks, and next 2 years probably you will see a reversal of that trend. I mean, if I were to just stretch that argument to FY16, 17 and 18 and look at the Nifty earnings growth for rest of the 47 companies, we've got around 12% earnings CAGR for the last 3 years. So the narrative at the headline level has been disproportionately driven by those 3 banks for the last 3 years, and it's made the earnings look far worse than what it actually has been.
Okay. And since they are peaking off, I mean, since they are troughing out, we should have a better 2019 or FY20 is what you're saying. But Gautam, you know,
absolutely.
You know, a lot of the Nifty indices, Nifty companies also depend on the global story. I mean, steel is affected by the landed price of, you know, by the global prices. Reliance is affected to a large extent by the global margins, the GRMs. And of course, the IT companies are all affected by the global growth story. Will that, you know, come to cast shadows? I mean, Bajaj Auto, for instance, 30% outside. Yes, please, sorry.
So, Lata, for any year and in any kind of market that we are in, we will always have some worries, right? Some risk factors. So, as corporate banks, you know, C's being a worry factor, you will have new set of worries, be it IT or refining or metal. So, for example, the point that you touched upon metal, we've been bearish on metal for last 1.5 years now. We've always believed that the cycle has peaked as far as the profits are concerned, and the multiples will reflect over a period of time, and that is what is happening now. However, metals have a very lesser representation on the large cap indices. So where we have gotten a big surprise in the year 2018, if I was just looking at the aggregate market caps of the sectors that we cover, we have seen a 23% fall in the automobiles pack as far as the market caps are concerned. So 2018 has been a year of defensives: private banks, IT, and consumer. These are the only three meaningful sectors which have given positive market cap accretion. Rest of the sectors, be it utilities or auto, telecom, they've been down in the dumps. And I think some of the sectors are obviously offering opportunities for the next couple of years. And somebody who has a period where he can look beyond May 2019, I'm sure there are a lot of bottom-up opportunities. And one of the factors which has changed in the last 12 months is the significant premium that mid-cap indices were having in January 2018. That has dissipated. While they are still expensive, but nowhere as expensive as they were 12 or 18 months back. So that is also offering some opportunity in terms of bottom-up stock picking. So while macro and rest of the global noise will always be there for the next 12 months as well, we will have to look beyond that.
Well, Gautam, I think we just have to hold on to that thought. The Nifty saw a bit of a bounce and it's moved back to the low point of the day. We've moved back towards the 10,540 as we were in conversation with you. So just keep an eye out on that mark. 10,500 will be extremely crucial now. Expiry tomorrow, 10,500 put is very, very active. Just keep that in mind. 10 lakh shares being added out there. So 10,500 mark, very crucial. But Gautam, as you were saying, some of those mid-cap sectors, they offer some kind of valuation comfort. Now, post the sharp correction, last 1 year, small cap and mid-cap index down 15 to 25%. From the mid-cap space, which sectors are looking good? Will it be IT, or do you see, cement looks good? Your take?
So Nigel, mid-cap is typically more bottoms-up than top-down. So in every sector, you can find a couple of good mid-cap ideas, be it financials, consumption, or discretionaries, or even cement for that matter. So mid-caps, you have to keep a slightly broader brush and not just get bogged down to a particular sector, because every sector will have a very different dynamics, and every mid-cap company has a very different bottom-up fundamental backdrop for them. So I won't pin down mid-cap as a pack to any particular sector, but across the board there are enough opportunities in the mid-cap space now, and certainly they are far more than they have been at any given point of time in the last 12 to 18 months. So we for one continue to remain very positive on some of the sectors where the earnings visibility continues to stay very high. So I think first half of 2019, while being more volatile in terms of sectoral performances, I believe that defensives will continue to do well, whether it is private banks, whether it is corporate private banks, or some of the auto names after having corrected so much should bounce back. I know for the next couple of months the outlook on monthly numbers is not great. Festive season has been bad, and because of the issues in NBFC, you might see some monthly problems in those auto numbers, but the valuations are now offering enough room for upside from where we are today.
No, that may be, but fund managers also have to beat the index. They can't look like they are way out of whack. Right now, the Nifty has broken through the 50-day, which you pointed out, 10,578. It's broken through the 20-day, which is, I think, 10,554 or thereabouts, 10,754. Now it's racing to 10,530. So, Gautam, will you be buying now, or does it look like a falling knife? Will you wait for 10,300 or something to buy?
See, Lata, 10,300 and 10,500 has a 1% difference, and somebody who has a long-term outlook, I don't think 1 year down the line you would be fretting too much about
now, you're not moving into cash.
10,300 or 500. If you have 20% plus earnings upside, plus bond yields at 7.2, 7.3% basically means that equity valuations are not out of the whack now.
No, Gautam, my point is, are you buying now, or would you think cash is a better option for some time, maybe for a month or so?
No, I've always believed in being invested, because taking cash calls is very difficult even in a stable market. So at any given point of time, every fund manager or investor will have some portion of cash. But significantly changing that cash call is a very difficult, especially in a market like India, where bottom-up opportunities are always screaming at you. So I would rather be invested. and be more focused on fundamentals than be worried about the noise in the next 3 or 6 months.
Okay. All right, Gautam, thanks so much for stopping by and giving us your view. Enjoy the last week of 2018, and wishing you in advance a very happy New Year as well. Well, the market's not looking too good, but let's take a short break. Up next, more on the markets as well as stocks.